Hello, and welcome back to Private Markets 360, S&P Global's podcast dedicated to enlightening and educating our listeners about the world of private markets from vast vantage points. Your Private Markets 360 co-hosts both sit within market intelligence. I'll start off with introductions. I'm Jocelyn Lewis, head of private debt commercial strategy.
And I'm Jocelyn's co-host, Chris Sparenberg, head of private markets commercial strategy. I'm a super fan of our corner of the investment industry. We're thrilled to bring our listeners exciting guests every month for discussions about industry trends and other topics of interest here on the podcast.
We sure are, Chris. And if you're interested in regular private markets content, hit subscribe and tune in. Ready to introduce our guest, Chris?
Let's do it.
Today's guest is Sven Gralla, Senior Associate at Hauck, Aufhäuser, Lampe Private Bank AG. Sven joins us from Dusseldorf, Germany, where he focuses on fund manager selection for the private bank's fund-of-fund business. Sven is also a founder and board member of the Next Gen Council that connects the decision makers of tomorrow in the alternative investment industry with an unbiased platform for professional and social exchange. And he is also an avid wake skater. Sven, how are you doing today?
I'm doing well. How are you, Chris and Jocelyn? Thank you for having me.
We're doing great. Thank you so much for joining us. So Sven, to kick things off, would you like to provide a short introduction to our listeners about your role and which division in the bank you sit?
I'm working in Capital 1852, which is the dedicated asset manager for private market products of Aufhäuser Lampe, which is one of the biggest private banks in Germany. Our mission is to give especially high net worth clients in Germany guidance in the private markets landscape, which means we have dedicated fund-of-fund strategies in different asset classes. My role within Capital 1852 is manager selection within the private debt team, which means I'm responsible for the entire diligence, but also for the monitoring and some research activities, which we also fulfill as a byproduct of our selection process.
Excellent. So you're investing for a private debt fund-of-fund strategy. And what are some of the differences between specifically the German market versus the institutionalized US market?
So when you compare the European to the North American market in general, the North American market is way more institutionalized, as you said. And that's also represented in the numbers, which are shown, for instance, by Preqin. For instance, the asset under management in total in the US is 970 billion, while the total credit AUM in the world is like 1.6 trillion. So like over half of the asset management worldwide is somehow related to US managers. So in general, we see like a lack of the development in the US compared to Europe in general. I would say the US market is a more homogeneous market. So you see more differentiation in terms of dedicated strategies, I would say. The story in Europe is somehow different. So you have like different languages, different legal systems, local networks, somehow a nationality or national bias, which is true for borrowers or PE sponsors, which means that you have a close connection in Europe between the debt fund and the borrower or the PE sponsor on the local ground. So you have also the differentiation by the region or the country in Europe. So I would say that's one of the major differences between the markets. Those conditions like language, legal system, local networks create some different dynamics, which means for single countries, you have entry barriers. Take, for example, Norway or Sweden. Those debt markets for the direct lending business are quite isolated in terms of the network itself is more important and the local relationship is more important. Obviously, you have also some pan-European managers which are entering those markets. But when you follow the league tables, the local managers are way ahead in terms of being close to the transactions and close to the sponsors.
Sven, that's fascinating. Can you tell us more about some of the reasons for those differences and more of the perspective from within Germany?
One of the main reasons for the differences in the dynamics is driven by the different cultures, different regions, different networks. But one more general reason for the lack development of the European market is shortly after the financial crisis, you had a more dense banking system in Europe, I would say. And after the regulatory pressure towards the traditional intermediaries, that created somehow a financing gap for mid-sized companies. That's essentially driven by the capital requirements for the traditional intermediaries. You also had like the regulatory shift in 2016, where we had the change in the regulation in Europe that due to the AFMD funds itself and can provide the capital for the debt financings without a frontier bank. So that's like the major political shift. It's also investor driven that the role of the corporate direct lending market is in Europe is increasing over time and catching up to the US, because you also have the investor demand, especially during the time of low interest rates, for some alternative to bonds, for instance. But nowadays, where you have an interest rate again, but also have like high inflation rates, there's a demand for real interest rates, interest rate over inflation. And that's essentially provided by corporate private debt, where the contracts are on a flexible basis. For the German perspective, one of the best sources, in my view, is, for instance, a survey which is conducted annually by the German Association for Alternative Investments, or BAI. And they analyze the drivers of allocation decisions of institutional investors. The total allocation to private markets this year is for German institutional clients at around 22.5%, which is to be increased by 3.5% in next year. And one of the strongest driver of this increase is private debt in Germany. At the moment, around 66% of German institutional investors are invested in private debt, and that will increase in the short term to 76%. So we still see, in times of denominator effect, we still see the demand from the investor side. From what I hear from peers or from investors, I would say this catch-up effect in comparison to other private market asset classes is a little bit slowed down by denominator, but it will be still persistent from my perspective, which is also the driver for a so-called investor sentiment barometer provided by this German Association for Alternative Investments.
Sven, can you tell us more specifically about the environment within Germany, the manager landscape, the investing dynamics?
That's extremely interesting, actually, because when we think about the European market, each and every country in Europe is somehow at a different development stage. I would say in Europe, most developed are especially UK and France. But I would say Germany comes next, actually. And there are different managers active in Germany. You have those pan-European managers, which are active in Germany, sometimes on bigger transactions, but also sometimes on low mid-market transactions with a regional footprint. You have a couple of emerging local managers. I would say it's like a handful of local managers which are solely active in Germany. Some of them are more active in the non-sponsored space. Some of them are more active on the PE-sponsored space. We have some managers which are more pan-European, I would say, but also with a strong German footprint, which are able to invest in more complex situations, which means going a bit across the capital structure. I would say there's a huge growth space for private credit in Germany in general, and also speaking about niche strategies, speaking about special situations, speaking about distress, but also ARR lending. I think there's a lot of growth space in Germany. And on the end of the lower local managers, one of the key constraints nowadays is fundraising in the current environment. But looking into 24, I think that will be better next year, actually, since institutional investors in Germany, which tend to also invest in Germany, will have some capabilities to invest again after the fundraising winter caused by denominator effect.
That's very interesting. Shifting our view to your role as an investment manager, how does that inform the decisions you're making with respect to portfolio construction, leverage levels, and then investing with larger managers versus some of these emerging managers?
If you want to invest and if you want to allocate capital, your main job is to understand the dynamics of the market. So that's extremely important. You need to have a clear view on the market structure, on the competitive landscape, on local managers. Sometimes some managers in Europe go back to like one or two bigger teams which split it up over time in order to build local managers. You have to follow those people, but also those strategies. And in the end, if you see how the dynamics of the market play out, whether some managers want to enter one region or some managers enter a specific niche strategy, you have to consider how the competitive dynamic will be in this industry. And then you decide how to construct your portfolio in the end. So it's important that you combine a lot of different aspects of the market.
So diversification then is a good thing to think about. It sounds from your comments in diversifying across managers, industries, different types of strategies. Would you say that that kind of sums up a lot of what you were speaking about?
Definitely. And the challenge in that is as a fund manager, you're somehow sitting between the chairs. You're at the same time GP and LP, which means you can understand the preferences of the LPs, but also see what the GPs are doing. And obviously, each presentation I receive every day in my business life look perfect. So obviously not in style and design, but in terms of content, every manager looks perfect. And the challenge is to standardize the data, to identify marketing language and drive your thesis through that. So for instance, talking about the perception that bigger is always better, which refers to the thesis that bigger companies are always more stable in terms of EBITDA. So that's like one of the things you sometimes hear, or for instance, PE sponsored transactions. So transactions where PE sponsor is involved are always more secure than non-sponsored transactions in direct lending. When you analyze the lower mid-market, we are also active in, you see that the EBITDA leverage levels of the companies which are financed are significantly lower compared to the upper mid-market. So our data shows that in the lower mid-market, average EBITDA leverage level for a company is like around 4 turns, while it's in the upper mid-market above 5 turns.
Yeah, and it also seems like there is a changing dynamic in the market too, where you have lenders that were traditionally in the middle market, they're able to do much larger transactions now. For managers that are looking to maybe slightly different pockets of growth, I guess you wouldn't really be able to look at their track record necessarily in a specific segment because maybe it's not one that they had particularly participated in previously. So then, any thoughts on how you would go about assessing whether or not that would be an investment that you would want to participate in that particular manager, being that you're looking for growth and the associated returns?
Persistency of strategy is one of the key decisive factors, I would say. As you mentioned, we had a couple of managers which were in the lower mid-market in the past, but then followed the incentive to raise bigger funds and also to get a bigger pie in terms of management fee and carry. And that creates a difficult dynamic in the market in the end, because you started doing small transaction of small bespoke situations, and now you end up doing competing with the syndicated market. And the way back to the lower mid market is difficult though. So you see a couple of spin outs which emerge from those dynamics of bigger managers in the market. But strategic focus is key in the manager's decision. So whenever I see a quite broad mandate of managers, that's something I really don't like in the decision process, because they can play around too much from my perception. It's a different story for special situations manager, I would say, because they need to have the flexibility in order to react quickly. But for direct lending managers or more direct lending like managers, I would say the more closer the limit structure and the more closer the mandate, the better from my perception.
I agree with you. It sounds that strategy focus is particularly important. So I think that in this existing environment where you're seeing those kind of spin outs, you're seeing all these different strategies, so many managers that have expertise. It's a quite interesting place where you sit that you're able to really take a look at the underlying portfolios, meet with the managers, and really make an assessment of where you want to invest.
Yeah, definitely. The interesting thing in being a fund of fund manager is that you see each and every manager, you see each and every transaction or data room, and you get far more better access to managers and insights compared to just going to the dataset provider. So it's quite fascinating. And it's also the combination of data research, but also people. Reading people is extremely important as fund of fund manager.
I remember back when I was on the investing side and when we were doing diligence on a portfolio, we'd always want to go, and it was just local markets in the US, but it was important to go and see the investment, particularly if it was backed, by real estate, but just see in its environment, how does that look compared to what else is around? Because when you make an assessment on something and you're not in that market, really kind of feeling and seeing how everything relates, you might miss something where you getting the advantage of being there in person, meeting with people. You really get that feel for the way that they do business, even the culture that exists within some of those funds, which is definitely important.
Absolutely. And with that in mind, Sven, we'd love to hear more about your thoughts on the manager selection process. Take us deeper into the risk factors that you're assessing as you look at these managers.
One of the key risk factors nowadays, and it changed since I would say 1.5 years, is ownership and succession. So especially, as I mentioned before, we see a lot of M&A activity between the different GPs, but also between bigger institutional investors and GPs. And that's one of the key risk factors from my perception nowadays, because keeping good people and attracting talent is one of the major differentiators of those managers, but also one of the major risk factors. So you see at the moment which manager did his job in terms of a good succession plan, and which manager needs to sell because simply the next generation of the leaders can simply not afford buying into this manager. And that's extremely interesting, because I'm a strong believer of people are driving organizations, but also good results. And since people are key for me and my manager selection, keeping people is one of the major risk factors.
Definitely. People, culture, the fit, the teams working together. I think that it's super important and how they work together, how they learn from different experiences too, and share those experiences really provides a competitive edge for them.
And it's also about incentivation in the end. So it's a question of how do you split the carry pool? How will the carry pool be split after such a transaction? What's the view of the next generation of leadership, which were responsible for extremely good results in the past for origination capacities, local origination responsibilities? So what does it do with those people if the option to buy in is off the table? And in those marketing stories and those mailings you always hear, it's perfect, the transaction makes sense. It sometimes makes sense. Sometimes makes sense also in terms of fundraising to overcome the fundraising issue of some managers or overcome some capacity constraints in the back office functionalities. But sometimes it creates some adverse effects in making people to spend best of their effort.
Absolutely. Well, thank you, Sven, for joining us today. It's been so interesting to learn about the dynamics of investing in Germany and across Europe. And thank you to our listeners for joining another episode of S&P Global's Private Markets 360 podcast.
Thank you again to our wonderful guest for a great chat today. We really appreciate everyone listening in. If you're looking for more private markets content, hit subscribe to catch future episodes and listen to our earlier episodes wherever you listen to podcasts. Cheers, everyone.
Thank you so much. You can also subscribe to our monthly Private Markets 360 newsletter. The link is in each episode bio or connect with us on LinkedIn. Have a great day.